Hey everyone, I hope you're doing well. This is another 5 Minute Finances video. My name is Drew Creekmer, and I'm the Director of Advisory Services here at Creekmer Wealth. And, we've gotten a number of questions from folks about a relatively new investment product called a buffer fund or a target outcome fund. And these funds themselves are relatively new, but the strategy behind these funds have been around for 50, 60, 100 plus years. And they're very well known investment strategies. Just now, they've been wrapped up into an ETF or a mutual fund. And these funds have performed quite well over the last number of years, especially during a time period like a 2022. So I wanted to walk through what a buffer fund is, where it may fit in an investment portfolio, and we'll talk about if you should consider investing in that or not. A buffer fund ultimately tracks a stock market index. Think the S&P 500 or the Nasdaq. And what this fund allows you to do is participate in the upside of that index up to a cap. And on the S&P 500, your maximum earnings over a 12-month period typically are going to be somewhere in the range of, let's just say 13 to 17%. And on the NASDAQ, that upside range over a 12-month period is going to be somewhere in the range of 18 to 25%. Now, your return to the upside is capped. So let's say, for example, the S&P 500 is up 25% like it was in 2024, but your cap in that 12-month period is only 17%. Well, then you're only going to earn that 17%. You're going to give up that additional upside. Now, while you're giving up some upside, what are you getting in return? Well, what you're getting in return is a certain level of downside protection. There's a lot of different iterations of buffer funds. A very popular one would protect against the first 10% of loss in a calendar year. So let's say, for example, you bought this fund on January the 1st and you held it all the way to December the 31st. And in that time period, the S&P 500 was down 20%. Well, your investment would only be down 10%. And so you're protected against that first 10% of loss. And there are a lot of different iterations as to how much downside is protected and what the cap is. And so it's critical that you understand that. But the reason these have become so popular is a lot of folks understand that buying and holding an index fund allows you to generally have very strong performance. Now, that said, though, markets don't always go up 25% or even 10% a year. There will be times of periods of volatility, like we saw in 2022, and we've seen a little bit here in early 2025. And a lot of folks like the idea of saying, hey, I'm okay giving up some upside return, but I'm able to protect the downside risk so that I don't actually have to make the decision of should I sell my index fund or should I hold it? It removes the emotional decision factor that, quite honestly, is one of the biggest risks for investors is making an emotional decision whenever markets are going down. A lot of people sell out in those situations, and the buffer fund is really a great way to hedge against that emotional risk. Now, with any investment product, it doesn't mean that's necessarily right for your situation. It's really important that you understand your goals and your personal risk tolerance and your timeline until you need the money from your portfolio. And a buffer fund may be right or it may not be right, but it's a really interesting way to address what is the biggest risk, which is making a poorly timed emotional decision when things are getting hectic out there and a little bit scary in the stock market, and a lot of people sell out at that point. Buffer funds are a way for you to still have a decent amount of upside earning potential, but also be able to protect against some of that risk of loss in a bad calendar year. And so what I would encourage you all to do, if you are interested in a buffer fund or you're looking at them, I would encourage you all to reach out to our team. We've been utilizing this strategy now for about 5 years. I've been incredibly pleased with it. Our clients have been incredibly pleased with it. But it's important to understand that you have to know your personal situation very well. And this may not be the right fund for your situation. And that's where a conversation with a trusted advisor really comes in handy. Our team is able to walk you through that conversation, help you understand what your risk tolerance is, and whether or not a buffer fund is right for your personal situation. So thanks for the time, y'all, and we'll talk to you all soon. Have a good day.